What's going on YouTube? It's Ganimo and welcome back to our channel. Today's video, we're going to be discussing what happened with the stock market this past week. Unemployment's up, stock market's up, morale's down. So let's dive into this together and try to figure out what's going on. So you guys know the drill, gingerly tap that like button and let's get started.
Bear market, recession, unemployment. These are just some of the headlines going on right now. How do you make sense of 6.6 million claims in the past week alone for unemployment? 17 million unemployed so far to date. And those numbers are only climbing from here. At this point, we're at 10% unemployment. Yet the stock market is going up. So what's going on?
Guys, we saw one of the best weeks this past week in the stock market in nearly 40 years. The Dow was up 13%, the S&P was up 12.5%, and NASDAQ was up 10.5%. But why? When we saw increased quarantine restrictions in states, businesses were closing down at rapid rates, and now we're restricting the number of people in stores. But guys, don't forget, the stock market is not based on current events as of today. Stock market is actually based on what the future may hold.
So it's virtually impossible to try to make any economic predictions at this point. But here's what we know. Scenario A. This virus and the shutdowns end in a month or two and then the economy bounces back right away. Scenario 2, the shutdowns extend even further, 6 months, a year, or we have another resurgence and then the economy takes a big down for the worse. But ultimately, nobody can make that prediction. Nobody can make any judgments about what's going on because this is unprecedented by nature. Nobody had dealt with a virus outbreak before. The only closest thing that we have is the Spanish flu back in the day. However, what do we know at this point? Are we really in a recession or is this a prolonged recession? So let's look at the data together. This economy is a lot different than the economy back in the day whenever the Spanish flu had hit. This is a more robust economy. This economy is actually not fueled by just agriculture and manufacturing like it did back in the day. We have different sectors and no one sector makes up most of the economy. We have technology, we have real estate, we have agriculture, we have manufacturing. But all those different sectors only make up about 5-10% of the market at most. Now, reason number 2. This is a self-induced recession. Previous recession was based more on fundamentals. For example, 2008-2009, that was based on the housing crisis. Another, the dot-com bubble, was based on stocks and people overbuying those stocks. And then now, this is because people are afraid to leave their house and businesses are reacting and the government is reacting to keep everybody safe and healthy.
Now, the historical context may actually give us a clue into what's going on. Now, when unemployment increases, actually that could drive our market higher. And why is that? Well, we're increasing the pressure on the feds. And the feds are going to start producing money and that's cheaper and more accessible. And that's actually going to drive investment grade bonds down and give us a signal that perhaps it's time to buy into the stock market. Now, with the current stimulus package, that actually influences investors to push more money into the stock market. So that might give us an idea of why this past week, with the recent pass of the CARES Act, our market actually saw awesome returns.
So in previous recessions or downturns, the feds were actually very slow to pull the plug and to help the economy. Versus this time, the feds stepped in quite fast and they rolled out several different stimulus packages to help us. So in the past, they actually tightened monetary policies, they tightened fiscal policies, and that affected the market in a very bad way. This time, the president, along with the different councils, decided that, hey, the economy will sink if we don't step in and learn from previous mistakes. So they rolled out the different CARES Act and the PPP programs for different small businesses to rescue the economy.
Now remember, the feds always have our back. If we see an increase in unemployment and our market is tanking, the feds are actually going to start producing more of a stimulus package. So $2.3 trillion may not be the end of it if we continue this trend on into the summer months.
And they actually just announced that there is possibly another $250 billion in additional money going into the economy. Look guys, I'm no stock analyst. I'm just a guy sitting in a brown chair reading the news just like you guys. But one thing I can promise you is that the headlines are going to continue. You're going to keep reading a lot of different gloom scenarios, worst case scenarios. Are some of them going to be accurate? I mean, if the more that you read those news, sooner or later, one of them is going to be correct. But what do you do with that information? Do you go sell your stock? Do you go buy more stock? Do you believe and jump into the pessimism crowd? Do you believe that this is the end all be all and that all your hard work has disappeared? I don't think so. There's always going to be a way to get out of this recession. This is just temporary, just like previous recessions. Even if this extends another year, you think that the whole world is going to shut down indefinitely? That's not a way to live, and nobody is going to accept that as a way of the future.
So as healthcare professionals, we don't need the added stress of the market volatility right now. The important thing is don't sit there and try to predict the upturn or the downturn of the market. I mean, you could use dips in the market to buy in at certain levels, but the important thing is don't try to study when the market will bottom out. And remember, you want to invest financially. You don't want to invest emotionally. You don't want to let emotion overcome your financial decision throughout this whole process, because there's going to be a lot of ups, there's going to be a lot of downs. And don't forget, when the virus and the quarantine is possibly over, we're also looking at a recovery process that can last months after that. People are going to be afraid to go out. People are afraid to spend their money. People are going to be afraid of certain things, and they might also cause another market volatility in that sense. So you want to stay the course and continue to do exactly what you're doing if you're already investing in the market. The goal right here is to buy long term. If you're looking to buying short term, now might not be the time to do it.
So some things that we're doing right now that you guys can do as well, and super simple, just try to max out your retirement accounts, try to buy the dips, try to stay the course. Those are the three main elements that you guys want to follow for long-term success in beating any recession. These are always going to be recession-proof. So on Friday, we're going to be releasing a video going into a lot more detail about how you can actually make some real money in this market.
So guys, we hope you thought this video was helpful with everything going on, especially in this past week. And remember, if you enjoyed this video and the content, don't forget to hit that like button, subscribe to our channel, and we look forward to seeing you guys on Friday.